Welcome back to Your Average Investor, the channel that looks at my journey through investing, budgeting and finance. Now, because the channel's been growing so well over the last few months, I've now got enough subscribers to actually properly do a Q&A video. So that's what today is all about, answering the questions that you have asked over the last few weeks, some of the questions that I haven't had the opportunity to write back to, and some of the questions that I'm really commonly asked, so I thought it would be a good opportunity to do a proper video to answer them in detail, so that you can all have the same answer at the same time. If you do enjoy videos like this, please do consider commenting below and also subscribing to the channel if you haven't done so already. The first question I've got is from Callum Timbrell, and he asks, am I still keeping up with matched betting? In short, yes. Match betting is an excellent way to make money every single month, so it's something that because I've started, I now continue to do because I'm used to making that income now. One of the things that I have done since doing match betting is not change the amount of outgoings I have every month. Because the income I make from match betting can vary quite substantially each month, what I don't want to do is overextend my finances to a point where I'm depending on my match betting income rather than my job income as well. I've been doing match betting now for about a year, and I'll be honest, it has started to get a little bit tedious. Not because I don't enjoy it anymore, but because I've been gubbed by several bookmakers, which makes it slightly difficult now to make consistent and large profits every single month. Now, this isn't to say that I can't continue to make profit from match betting long term. Over the last 2 months I've made £200 a month, and I've not really put that much time into it. So it is something that I can still keep ticking away in the background, but I'm not doing it as consistently as perhaps I was at the beginning. As I always say though, if you are interested in match betting, it's an excellent way to make money, up to £1,000 every single month, and largely risk-free. So if you are interested in it, please do check out the link below to Profit Accumulator, the software that I use, and check out one of the videos up above to match betting, which will hopefully give you all the information you need to get started. Kyle McBride asks, would I ever consider making a video showing how to purchase ETFs for less than a £500 initial lump sum investment? He says he's already invested £1,000 in the Life Strategy 100, which in my opinion is an excellent fund. But he's asking, do you have to invest the minimum one-time lump sum of £500 before you can then invest further into each ETF? In short, yes, I will be making a video on this in the future. However, it's fairly simple. As soon as you've opened up your Vanguard account, it's very easy to invest very small amounts into individual products. Like you, I started out by investing £500 into the Life Strategy 100 when I initially started my Vanguard portfolio. Since then, I've invested really small amounts from £50 right up to a few £100, depending on how much I've got and what I want to be investing in. So once you've made that initial investment into Vanguard, you really can add as small amount of money to your account as you want. And there are no fees for doing this. You can even add as small as £5 in cash to your portfolio. And whilst holding cash might not be everybody's idea of good investing, that just shows that you can invest really small amounts into the platform. So in short, yes, you can do that, and I will be making a video on that in the future. We've then got Hambo04 who asks, why am I holding cash in my Vanguard account? At the moment I hold around £134 in cash within my Vanguard account, as you may have seen in previous videos. In short, the reason I've currently got some cash in there is because I invested quite a lot at the beginning of the month. And what I try not to do is invest the whole amount at one time. Instead, I try to pound cost average throughout the month if I've got a large amount to invest. And this obviously accounts for the variation in the cost of each product, and obviously helps me to average down or average in to the ETF. This is part of my pound cost averaging strategy, and if I have got a bit of cash left in my account, it's because I haven't then invested towards the end of the month again. It will be invested most likely in the S&P 500, but for now it's sat there because I invested in 2 products of the S&P 500 at the beginning of the month, and I didn't want to invest in more at that time at the price that I had then. Hambo also asks, would I consider building up an emergency fund for house repairs and other sorts of bits and pieces like that within a Vanguard fund? And my simple answer is no. What I do is I also hold an emergency fund in a savings account, come current account, which offers a good level of interest. The account I hold my emergency fund in at the moment is the TSB current account. It initially got 3% on money up to £1,500, but obviously that's now been reduced. So as long as I put £500 into this account every month, up to £1,500, I now gain 1% interest on the amount in the account. Now this does obviously mean me sending £500 across to my TSB account and then instantly withdrawing it, because anything over £1,500 earns no interest. There's absolutely no point in keeping any more money in there. So I move £500 across when I get paid, I then instantly take that £500 back out of the account, and I achieve 1% on that a year. This is obviously safer than keeping your emergency fund within an investment product, because that could obviously subject to variation. Whereas I know that £1,500 is safe within the TSB account, and obviously I have emergency funds elsewhere, but I know that that money is secure and safe there at the best rate of interest that I could find at the time. I do also have other savings accounts which earn slightly less interest, but they're also obviously part of my emergency fund. An emergency fund is probably a video that I will concentrate on in a few weeks' time as well. We've then got Hugo Orca, who asks lots of questions about trading 212 and Vanguard specifically, and what is the difference between the two. Now, this is something that I will be spending a video on in the future, because I think it's a really important question. Because you can actually invest in Vanguard products through trading 212, why do people choose to invest through Vanguard rather than the slightly cheaper trading 212 option? As we know, all Vanguard products have an ongoing charge, varying between 0.07% up to around 0.22% for the life strategy funds. This is the cost of investing in those individual funds, and you'd have to pay that ongoing charge fee no matter whether you invested through Vanguard or whether you invested through trading 212. Now, the difference between investing through Vanguard and trading 212 is that Vanguard also has an account fee of 0.15%, meaning you will pay 0.15% of all of the money within your account per year for investing through the Vanguard platform. Vanguard's fees are currently capped at £250 per year, and that's something that I don't expect to be reaching for a long time, maybe even never, so that's not really something that concerns me at the moment. However, when we have a look at trading 212, they are a completely free investment platform, meaning all you will have to pay is that ongoing charge fee. You will not have to pay an account fee as well. So let's have a look at an example. If we invested in Vanguard's S&P 500 product through the Vanguard platform, we would pay an ongoing charge fee of 0.07% and also an account fee of 0.15%, meaning that your total fees on that product and the account would be 0.22%. If you move across to trading 212 and we invest in the same product, we will not pay an account fee, we will just pay the ongoing charge fee of 0.07%. Essentially, you are saving 0.15% per year on the overall value of your investments. Now, while that is really important, personally I really like the Vanguard platform at the moment. I like the way you can track the growth of your investment. I like the fact that it gives you time-weighted return rather than actual return, so that the money that you then reinvest doesn't alter the return that you're seeing. I also like the security of investing through Vanguard, and whilst I'm not saying trading 212 is not secure, Vanguard has got a proven track record of consistent growth and of consistent security over a prolonged period of time, whereas trading 212 is somewhat more new. Whilst I hold some money within trading 212, the vast majority of my investments at the moment are through Vanguard, and this might be something that changes into the future as the account fees on the Vanguard product keep going up as I invest more, and I'd like to potentially save that by moving across to trading 212. Now, the only difference here is that trading 212 doesn't yet offer Vanguard's Life Strategy 100, so I would probably still have to keep my Vanguard product open so that I can continue to invest in that product. So moving on to the next question, Jeffrey asks, how do I decide how much to invest in each fund each month? And do I invest a certain amount in each fund each month? That's a really, really good question. And I'll be perfectly honest, at the moment, I don't decide how much to invest. I just decide on the month what products I want to be investing in. And that may not be the right approach. Because at the moment my investment pot is relatively small, I just want to get as much money as possible into the Vanguard platform as quickly as possible. So I'm investing in the products which I see the most amount of growth in long term. So I continually invest into the S&P 500, I do invest into the FTSE 100, but I haven't been doing so much recently, and the Vanguard Life Strategy 100, as well as smaller amounts within the FTSE Emerging Markets and the Vanguard Asia Pacific ex-Japan. Now, once I get my investment pot up towards £10,000, what I will be concentrating a lot more time on is the geographical diversification of my portfolio. Now, this is something that's important at all times, but as I said, to start off with, I wanted to get as much money into Vanguard as possible, so that's what I've been doing. However, geographical diversification is something that's really important, especially as your investment pot starts to get larger and larger. If I invest around 25 to 50% of my money within the US market, and the US market tanks, then I will be in great difficulty because I will potentially have lost quite a large amount of my investment. So what I would rather do as I get towards a larger amount is then start to, as I say, geographically diversify across the world's markets. Obviously, I will still have an element of bias towards the American markets because I see them as being the strongest market in the world at the moment, and especially for the longer term. However, geographical diversification is something that I will be concentrating. The next question is from Mac33, and he says, do you think it's too expensive to buy into Vanguard's S&P 500 now that one unit of the fund costs £51.75? He said he's interested in investing in a lump sum into the fund, and he was just wondering whether it was too much at the moment or whether he should hold off. From my point of view, you should be investing as soon as possible because time in the market is better than timing the market. Whilst it might be £51.75 at the moment, in 10 years, 20 years time, it will likely have increased. People thought that companies like Tesla and Amazon were really expensive a few years ago, but look at them now. They've gone from strength to strength and continually grown over time. If you factor in that the S&P 500 will soon be taking Tesla into there as well, there's every chance that the value of the S&P 500 will increase in the next few months or years. With that said, Mac33 also says that he wants to invest a £5,000 lump sum. Now, granted, what I just said was time in the market is better than timing the market. However, I would strongly advise that you pound cost average into the funds rather than invest in a single lump sum. Maybe investing £500 of that a month for the next 10 months, or investing £1,000 of that a month for the next 5 months. And what this will enable you to do is to average in at the cost of the investment. So if the value of the fund drops by 5% in the next month, you'll then be able to buy in at a slightly lower price. Whereas if it does increase, you'll have still bought in at the lower price as it is now, compared to what it will be in a month's time if it does go up. And what that will enable you to do is to average into the fund and even out any of the variability that we see in the value of that fund. The next question is from Hyper Alarm 4, and he asks, how much as a percentage of my total income do I invest every single month? And that's a really interesting question. I do currently have a few different streams of income. I've currently got my day job, income from match betting, and income from an affiliate scheme that I also work through. Now, because income from match betting and the affiliate scheme can work slightly differently, I haven't got a specific amount that I make every single month. Because of this, any percentage that I give you will just kind of be a ballpark figure. So what we'll do is we'll pick last month, the amount that I made and the amount that I invested. Last month across all my platforms I invested about £600 across my Vanguard platform and my Trading 212 platform. And that equates to around 25 to 30% of my invested income from last month with regard to the amount I invested and the amount that I earned last month. Now, the final question I've got is from Sean O'Grady, and he asks, why do I invest in the S&P 500 ETF when it's already combined within the Vanguard Life Strategy 100? And this is a question that I've seen quite a lot on my videos. In essence, the reason I do this is because I'm really bullish about the S&P 500. The rate of growth it's seen historically, along with the quite nice dividend that you get from the Vanguard product, really does help to support the overall growth of my portfolio. Whilst Vanguard's Life Strategy 100 is an excellent product, which also has geographical diversification, as I've said, I'm really bullish about the S&P 500, and I think that this will do really, really well over the next 10 to 30 years. Therefore, by investing more money into the S&P 500, what I'm essentially doing is changing my geographical diversification and changing the weighting to each of the geographical regions, placing an increased importance on the US market. Now, this is all down to personal preference. If you thought the UK was going to outperform the American market over the next 10 years, you may invest in the Life Strategy 100 for that geographical diversification, but also invest in Vanguard's FTSE 100 ETF to change your geographical allocation and weighting towards the UK market to reap the rewards in the market that you thought was going to perform well over the next period of time. Now, this is in essence the reason why I'm invested in the S&P 500, as well as a number of the other ETFs that I'm invested in. I use the Vanguard Life Strategy 100 to give me a broad fund that goes underneath everything else as a basis for a large geographical diversification as it invests in 10 different individual ETFs. What I then do is I cherry pick 3, 4 or 5 different ETFs to tack onto that in order to change my weighting to areas that I feel are going to perform well in the next 10 to 15 years. Essentially, it's the same kind of question as asking why somebody invests in the S&P 500 ETF, but then also invests in companies within the S&P 500 as individual stocks and shares. In essence, you're doing exactly the same thing. You're changing the weighting of that ETF to have a bias towards a specific company or a specific industry. So that is essentially why I do that within my portfolio. I want to change the geographical allocation and weighting towards certain or specific areas and funds. And that's about it. I've tried to answer as many questions as I can today, giving as detailed answers as possible in order to answer your questions. So I hope you've enjoyed this video. If you have, like I say, please do drop a like and a comment on the video, and also consider subscribing to the channel if this is the first time you've seen my channel, because we do lots of videos here on investing, budgeting and all things money. If money is something you're really interested in, I've already spoken about Profit Accumulator, but why not also check out Trading 212, which is where I hold around £1,800 of my investment portfolio at the moment in individual stocks and shares. If you haven't used Trading 212 before, why don't you check out one of the links below? By signing up through one of these links and investing just £1, you will get a free share valued worth up to £100. So in essence, it is free money. And also by using that, one of my subscribers will also get a free share, as all of the links below now are from my subscribers. So once again, thank you very much for watching this video. It really does mean a lot. You continue to support me by liking, commenting and subscribing to the channel, and hopefully I'll catch you all in the next one.